House prices are a national obsession and they make up about half of UK wealth. But what if I were to tell you that house prices in the UK today are exactly where they were 20 years ago? Stay tuned to hear more about that, but also in this video we'll talk about the overall UK market, where we are now, but also the regional property markets, and we'll also talk about the turnaround that we're now seeing in house price growth, and we'll look at where we might be headed in future and the drivers of that long-term house price growth. This video is sponsored by FlexiSpot, a company that produces smart furniture for home and work. I think a good place to start is to look back over the long term. And here I've got data from Nationwide between 1973 and 2018. And that's so I can compare it with UK wages. Note that if we compare house prices in the UK against total pay in the UK, then the two track each other pretty closely. And that's not a coincidence. If we're buying a house, we often do that by borrowing money, and the bank will lend us some multiple of our income. So this relationship between wage growth and house prices is a strong one. And if the two ever get very much out of sync, then that suggests that either house prices have to fall to match wages or rise to meet wages. Notice also that house prices and wages in the UK beat inflation in the UK over this period. So house price growth over this period was 7.2%. It slightly outstripped wages, which grew at 6.7%, and inflation lagged well below both of those. It was only 5.6% on average. So whenever we're thinking about some price increasing over time, over long periods, you always have to compare it with inflation. And if you strip out inflation, the rates of growth of many investments, including property, never look quite as good. So going back to that Nationwide data, they have quarterly time series going back to 1973. And here I've had to cobble together two inflation series because the ONS data only goes back to 1988. So before 1988, it's RPI data. After 88, it's actually CPI data. But once we subtract inflation from the rate of return, and here I've broken it down by region in the UK, the average rate of return, which is the number you see in each of these boxes, just doesn't look very impressive at all. Overall, for the UK, you can see that the average real rate of growth of house prices is around 1.1%. So they've beaten inflation by a shade, but really not by much at all. If we were looking at global stocks, we'd expect something like 5% above inflation. And there's also quite a bit of regional variation here. London, for example, had an average rate of real growth of about 2%, whereas Scotland and the North had a much more modest 0.5 or 0.6% rate of real growth. So just remember this relationship between inflation and prices as we go through the video. It's very important. So where are we now with the housing market in the UK? If we look at the monthly time series from Nationwide, this has just been updated, and the latest average house price is about £258,000. Notice that it did peak recently and it has fallen from that peak. That was because interest rates surged as inflation surged and the Bank of England had to fight rising prices. That meant that the cost of funding for mortgages increased very rapidly, and that had a huge chilling effect on the UK property market. Now, if we want to think about the crashiness of the UK housing market and place the recent fall in a longer term context, what we can do is look at the drawdowns. That's the fall from the previous all-time high. So let's say house prices reached an average of £100,000 and then fell to £50,000. We'd look at that percentage fall relative to the previous peak. And you can see that the current fall is around 5% relative to the most recent all-time high. And the UK market's been off that high for about 1.5 years so far. There are two periods in the past where we've had very significant falls in house prices. One of them was in the 1990s. You can see that ran from 1991 to 1996, and the depth of that fall was considerable. Peak to trough, it was about 10%, and then we had an even larger fall during the global financial crisis and in its aftermath. So that lasted 6.5 years for prices to regain their previous all-time high, and the size of that fall was twice as large. It was about 21%. So in that context, this hasn't really been much of a crash at all. I think house prices in the UK have been very much supported by a lack of supply. But now let's turn to the controversial statements that I opened up with. What would happen if we took that index of house prices and adjusted it for inflation? Well, here's the shocking graph. What you can see is that there was a huge rally in real house prices at the end of the 1990s to the mid-2000s. But since then, since the global financial crisis, in fact, and that's not a coincidence, what we've seen is a flattening of house price growth. So in real terms, current house prices are £258,000. But if we use today's buying power for money in the past, then what we can see is that we were last here in 2004. Correcting for the buying power of money, in June of 2004, house prices were higher than they are now. They were £260,000. So part of the recent fall that you can see on this graph is due to house prices falling. Another large contributor is due to inflation. That's pushed down the price of housing in real terms. And if we repeat that analysis, looking at the fall from the previous all-time high, and do it for the regional breakdown of UK house prices, those drawdowns look much deeper and much more severe. For the UK, for example, we're still in a drawdown. We're about 20% below prices when we had the global financial crisis. So the numbers you can see on these graphs, max is the maximum drawdown over the period since 1973, and now is the current drawdown. Ireland is the one that really stands out because that had a huge surge in prices, which then quickly abated. And according to this nationwide data, Ireland is currently 56% below, in real terms, the prices that it peaked at over a decade ago. Today's video is sponsored by FlexiSpot, a creator of smart furniture for home and work. And after I've spent a difficult day creating videos here in this studio, I like to spend time relaxing. I've always wanted a reclining chair, so I was really delighted when FlexiSpot offered to sponsor this video. Now, I'm much better at teaching people about investing than I am at DIY. So I was delighted to find out that the construction of the chair, the assembly, was actually very easy. My FlexiSpot XL3 riser recliner elevates my relaxing to a new level, as it not only lifts and reclines, but also has massage and heat settings. It's also customizable with a heated vibration and massage control. The lumbar heating function combined with the massage creates a relaxing experience. That's great if you suffer from back pain, as I do. Its multiple reclining angle adjustment is adjustable within the 110 to 140 degree range. It can also lift with a weight capacity of up to 150 kilograms. The chair has pockets, and the 2-button recliner switch is located on the armrest. It also has a USB port for device charging. That's really convenient because I often use my mobile and my tablet while I'm in the chair. The only downside to the chair is that my dog Teddy's upset because I won't let him sit on it. If you want to find out more about my FlexiSpot XL3 recliner, then there's a link to that and other sofas in the description below. But there are signs that prices are starting to recover. If we look at the year-on-year change in prices from nationwide, and here we're not adjusting for inflation, the blue regions show you when the year-on-year change is positive, red is when it's negative, and we're just coming out of this period of price falls into a period of price rises. This is the first time in over a year that house prices are rising year on year. And that's corroborated by data from the Zoopla survey, which you can see here, which actually breaks down by region as well. You can see that regions which are expensive, like London, suffered the largest rate of price falls recently. You can see that all the regions have now started to turn the corner, and we're seeing some regions go back into growth. Some regions never left growth, Scotland for example. And while London is still falling in year-on-year terms, according to Zoopla, it is starting to creep back into positive territory. Now we can also look at other measures of housing activity. It doesn't have to just be prices. For example, if you look at buyer demand, that's also up year on year. So is number of sales agreed, so is flow of new supply, so is stock of homes for sale. All of that is pointing to a recovering market. And to read from Zoopla's report, the reality is that the housing market is still adjusting to the impact of higher mortgage rates and the impact of reduced buying power. Also that sellers need to remain realistic on pricing and celebrate the fact that their house is likely to attract more buyer interest. It is important, however, that sellers don't start expecting more for their homes. So higher volume, higher interest, but not a huge surge in prices, according to Zoopla. So now let's see where the drivers are telling us prices might be headed. The elephant in the room for house prices in the UK, of course, is interest rates, which have surged since inflation has surged, and this is because the Bank of England's been raising interest rates. It turns out, however, that if you're looking for a 2-year, 5-year fixed mortgage, what matters is something called the interest rate swap curve. That's because when a bank lends to you at a fixed rate, it actually hedges that in this interest rate swap market. So the rate you get will be the swap rate plus some additional spread for your credit risk. If you borrow more against the value of your house, you'll pay more. And it's certainly true that the swap rates have fallen a lot since we had the crazy budget from Liz Truss, and also the secondary peak we had in those rates in the summer of 2023. But from a low at the beginning of this year, what we're seeing also is that those rates are starting to creep upwards, probably because it looks like inflation's stickier than we originally thought here in the UK. And if we look at Bank of England data on 2-year fixed mortgages, broken down by the amount of the value of the house that you're borrowing, you can see that if you're borrowing 60% of the value of your house, the rate is much lower than if you're borrowing 95%, say. And we have seen those rates come down significantly as the swap rates have fallen. So if you are thinking about fixing your mortgage, I think you'll probably get better rates later on this year as interest rates fall. What really matters is what happens to UK inflation, which in turn depends on what happens to UK wage growth and the Bank of England's policy. But my view is that you're probably going to be better off waiting to fix your mortgage, and that's because rates are falling. So where are we heading in terms of wage growth? Well, according to the Bank of England, they expect wages, which are currently growing very rapidly, partly to compensate for higher inflation. But as inflation falls, so will wage growth. And the Bank of England expects it's going to fall to around 3% per year. Now, if inflation falls to its target, which is 2% per year, then we'll be talking about 1% real wage growth. And as we saw, real wage growth drives real house price growth. So in terms of real house price growth, I'd expect it to fall to around 1% over the next 2 or 3 years. And that would, of course, be the long-term average. And we are starting to see that fall in the rate of wage growth in the UK already. The rate of inflation's fallen and the rate of wage growth has too, although with a lag. Now, the Bank of England is keeping its eye on that because if it doesn't fall, the rate of wage growth, then services inflation, which is driven very much by wages, is likely to remain sticky and their policy rate will also remain high. And let's end with some nationwide data on expensiveness. So this looks at the average price of a house in the UK, broken down by region, relative to the average wages in that region. So this is called the price to earnings ratio, very similar to the price to earnings ratio for something like stocks, for example. The standout expensive region, of course, here is London, where you're paying about £10 for your house for every £1 of earnings that you've got on average in that region. Compare that with the north, where you're paying £4.2 for every pound of earnings which you're generating. So there's a huge divergence here in valuation between different regions in the UK. And I think this is still high enough. You can see that for almost every one of these graphs, they're creeping up slowly over time, that it's going to have a chilling effect on the property market. The upside for house prices is always limited when valuations are very high. Because if we think about house prices in these terms, well, it's the average wage multiplied by this expensiveness multiple. And either house prices have to get much more expensive relative to wages, or we have to have wages increase rapidly. And I can't see a catalyst for really large wage growth in the UK right now. So the only way for prices to increase is for expensiveness to increase. And I think the scope for that is limited given how expensive prices are now. So to summarise then, we are starting to see interest rates fall, and the recent increase is probably a temporary one, I think. Once we start to see inflation really subside, then the Bank of England will start to cut rates, and I think that'll push down the entire yield curve. And that'll mean it's going to be cheaper to fund a mortgage, And it also means that's going to be a positive for house prices to increase. Now, I say it's a positive. If you're someone young trying to get on the housing ladder, that very high price to earnings multiple that we see right now is stopping many people from entering the market altogether. So we haven't really had a big shakeout in the property market at all. And I think that's a problem. There's a lack of supply in the UK. But if we are looking at house prices long term, just don't forget that they're driven by wages, and just be reasonable about what to expect in terms of house price real growth. That, I think, is likely to be something like 1% above inflation in future, as it has been in the past. Now, don't forget our offer from FlexiSpot. If you want to see a link to my XL3 and their other sofas, that'll be in the description below. And, as always, thank you for listening.